A unit trust is a regulated investment vehicle that pulls together the money of many investors. A professional investment manager uses the pooled money to invest in a selection of underlying assets, according to the unit trust's investment objective. The underlying assets earn returns through capital growth, income, or both. These returns are shared among investors. Each unit trust is split into equal portions called units. When you invest into a unit trust, you buy units. Your selection of unit trusts will determine your potential investment returns, as well as the types and levels of risk you might face. Pooling your money with other investors allows you to invest using relatively small amounts of money. Unit trusts also allow you to have exposure to a wider range of underlying investments than would be possible by investing directly into the same assets. This diversification means that your risk can be spread among investments that behave differently. Expert investment managers make the decisions about which underlying assets to buy, in line with the unit trust's objective and rules. The investment manager must adhere to a mandate or legal contract that sets out the investment objective and how the manager intends to invest to achieve this objective. Unit trusts have transparent fee structures that are regulated within the industry. Unit trust management companies are required to calculate and publish the fees and expenses for each unit trust, according to standardized guidelines. Each unit trust must also publish a fund fact sheet showing the unit trust's objectives, fees, and other information. Some unit trusts focus on maximizing capital growth by investing into assets that the manager believes will grow in value. If the value or prices of the underlying assets increase, they may be sold for more than when they were bought, and the unit trust makes a profit. Other unit trusts aim to deliver returns in the form of income by investing into assets that are likely to earn dividends or interest. And others invest into a mix of assets that are expected to earn returns through a combination of capital growth and income. When you have invested into a unit trust, the units you own represent a portion of that unit trust, while the unit trust itself owns the underlying assets. You will share in both the capital growth and the income the unit trust earns. If the unit trust earns income, it is distributed among all the investors who own units, in proportion to the number of units they own. Investors may choose to have their share of the income paid out to them, or may use it to buy more units. If you choose to buy more units, you will benefit from compound growth on your reinvested income. It is important to remember that your return may not be the same as the return of the unit trust you're invested in, depending on the difference in the unit price when you buy and sell your units. The total value of a unit trust is called the net asset value, or NAV. This is the value of all the assets the unit trust owns, less the expenses incurred in running the unit trust. The value or price of each unit is calculated by dividing the NAV by the total number of units owned by all investors. As the value of the underlying assets change, the price of each unit will change. Your investment value is determined by the price and the number of units you own. Therefore, Your investment value changes as the price changes, or if you buy or sell units. If the unit trust you are invested in earns returns through capital growth, the unit price increases and the value of your investment increases. If the prices of the underlying assets fluctuate, then the unit price and therefore your investment value will also fluctuate. If you sell your units once the price has dropped, you may make a loss on your investment. When you invest in a unit trust, the number of units you buy depends on the unit price at the time. For example, if you invest 100 Rand and the price of a unit is 10 Rand, you will be able to buy 10 units. If you invest when the unit price is 5 Rand, you will be able to buy 20 units. Once you have bought units, the value of your investment will change as the price of the units you own changes, depending on the value of the underlying assets. Using the example of a 100 Rand investment, if you bought your units when the unit price was 10 Rand and you owned 10 units, if the price of your units then drops to 9 Rand, the 10 units you owned would no longer be worth 100 Rand, but would now be worth 90 Rand. On the other hand, if the price of your units then went up from 10 Rand to 12 Rand, your 10 units would be worth 120 Rand. Since your investment value is the number of units you own multiplied by the price of each unit, your investment value will also change if you buy more units or if you sell part of your investment.